Jones and Nate Peterson joining me from the Schwab team. Kathy's the chief fixed income strategist, and Nate is the director of derivatives analysis at the Schwab Center for Financial Research. Kathy, we've had a pretty busy slate of Fed speakers. Bonds continue to just kind of drift lower in price. Does that seem to align with the message that we got from the FOMC and now what we're hearing from individuals?
Yeah, I think what we got from the Fed was, we're going to cut rates and we're going to be data dependent, just as we have been, but we see inflation coming down and we're worried about the labor market. So when we get data like today on jobless claims, it's pretty good. And then we get GDP numbers that are pretty good. The bond market, the longer end of the market looks at that and goes, well, maybe not so fast here. So I think we're in that data dependent phase where we're still evaluating every data point in relative to what the Fed might do. But all things considered, it was kind of just a bounce around in a range type day for most of the trading day.
Yeah, right now it seems like that 3.8 for the 10-year, kind of a line in the sand. We're not quite ready to cross just yet. The stocks generally okay with yields below 4. Nate, it is something that we've been kind of debating here because it seems like the logic is that we should be rooting for good data, which seems to be leading to higher yields. But you never know when the stock market has a problem with it.
Certainly, yeah, I know. And there's been that, schizophrenia in terms of is good data good data. We are in the good data is good data camp. I think the market feels like we continue to get some of these reaffirming time and data points today. Durable orders, initial claims, like Kathy said, GDP, all that looks pretty healthy. So then you turn to, okay, well, let's just assume that the soft landing is in place because that's what we're priced for. Then what do we need to look for in terms of what to be potentially concerned about? Well, it's going to come down to earnings. If you look at Q3, the estimate, it was 6.9% VFAX set back in July. Now it's 3.2%. We've also got 15% priced in for next year. So we'll have to continue to monitor that. If markets continue to melt up, BMO has a 6,100 year-end price target on the S&P 500. You'd have a forward PE of 24 if you get there. The problem with that is that you really get priced to perfection. So any kind of, introduction of something that challenges that narrative then can lead to a sharper pullback. But right now, it just feels a little bit like melt-up mode. We're about to get out of September, move into October, more seasonally bullish. Can we melt up into the elections without getting a hiccup in volatility? Probably not. But right now, it still feels like the momentum here is to kind of melt up.
VIX right now, 15.5. Nate, a little bit higher on an up day. Does that catch your attention? When does it get interesting? VIX up, stocks up?
Well, right now, I think it has about 2 points of premium in there for the election. If you look at the term structure, the futures for October, we're at 18.5. And I think that just speaks to the historical kind of norm to have higher volatility around the elections there. It's a tight race. We could just get a split Congress, and that may not make that big of a deal. So, with the S&P at all-time highs, you would think, oh, well, the VIX logically should be around 52-week lows, 12, 13, somewhere around there. So it's got a couple points of premium. It's not really seeming to be acting unusual. I just think there's 2 points of premium that's embedded in there.
Okay. Like that. Interesting. Kathy, tomorrow for inflation, given that data points are live and it seems we are responding to the numbers as they come in, consumer confidence, create a little volatility. Today we got a little volatility. For the kind of range, what's tolerable then tomorrow for inflation, you think?
Well, we got a lot of the data inputs for PCE ahead of time, so it shouldn't be too big a surprise. It should come in around 0.2%, give or take a little bit, but the market's very sensitive to any of this information. So I guess if we edge up to 0.3 or more, that would be bad news for the bond market. If we edge down to 0.1 or less, then that would be good news for the bond market. But again, when you kind of look at where we are, Nate referenced term structure, for the equity markets in the bond market. The term structure is really such that it's priced for following the Fed path that's in the dot plot. So, 2% growth, lower inflation, Fed easing. So we need something that's going to throw us off of that path to get a big move in the longer end of the market, and we're just not seeing it.
We are getting pretty big uninversion generally. 30s to 2s had the big move. 10s to 2s had a pretty decent move. The bearish steepening that we've gotten post FOMC, is that encouraging to you, Kathy? Do you think that's the bond market telling us something positive about the economy? Peter Schiff was arguing to us earlier. It's telling us that people are going to stop buying treasuries again and we're going to see a big blowout in rates.
Yeah, I don't agree with that. I think we're normalizing the yield curve. And you're talking about a bear steepening, and we haven't moved off that 378, 380 area on the 10-year for really a long time. We've crept up over time, but we haven't seen a lot of movement out there. So if we're going to get a blowout, you need to get towards 4% to get people worried. And frankly, I think if you get a 10-year at 4% plus, you'll find buyers come into the market.
All right. Like that. It seems like so far we've been finding those buyers at 3.8 basically. So 4, I imagine they're going to be pretty active too. Thanks, guys. Appreciate the thoughts. Nate Peterson, Kathy Jones.